Last video, we introduced managerial accounting, and we said that the managerial accounting was really used for making internal decisions within a company, and it was going to provide us information to make decisions like how much does it cost us to produce a particular product. And that's a really important question, because if we know how much it costs to produce something, we know how much we can sell it for, and we know how much profit we can make out of it. So in this video, I want to kind of go through an example of how you would do that, how you would cost your products with a real basic example. And this will also introduce some terminology that you will need to do for the rest of the course. So let's say that we are a manufacturing company. Let's say that we decide to produce race cars. We had a race car right here. And let's think about what costs are involved in producing this race car. And now some of this is really obvious. I mean, we know to produce this race car, we'll need something like steel, we'll need plastic, we'll need tires, and probably a lot of other stuff you guys can think of. I'll just put etc. But all these things are directly related to the car with the materials that are directly tied to the car. And so we'll call all this stuff direct materials. So the cost of all of our direct materials are obviously part of the cost of the car. But there's other things that are involved as well. Someone's going to have to put all this stuff together in order to produce this car. So we're going to have some labor costs over here. We're going to have a production worker who kind of puts the car together. So the cost of the production worker is obviously part of the cost of the car. And since the production workers are directly working on the car, it's easy to tie this cost to the car. So we're going to call this direct labor. So it's pretty obvious direct materials plus direct labor is part of the cost of producing one of these race cars. But there's other costs also, and this is where it kind of gets a little tricky. We also have a factory where these cars are produced. I have a factory over here, and there's a lot of costs associated with this factory that we have to pay, like electricity to keep all the lights on. We may have to pay a security guard to guard the factory. We may have to pay the maintenance on the factory, and so without the factory, we can't produce the car, right? And so the cost of the factory is obviously part of the cost of the car, but it's not directly tied to the car, and so it's hard to say how much of the factory cost would go to each car, especially if you're producing a lots of different types of cars. It can be a real challenging problem really, really fast. And so the factory cost is going to be something called as an overhead. And so our direct materials plus our direct labor, plus some part of the overhead will be part of the cost of the car. Now, an overhead is really anything that's indirectly tied to the car that we have to allocate to the car. And so overhead could also include things like indirect materials or indirect labor. So indirect materials are materials that are hard to trace directly to the car. They may be directly related, but they are hard to trace. Say for example, we use glue in manufacturing of these cars, and we have a big tub of glue, and it's hard to decide how much glue is used on each car. And if we could maybe keep track of the glue that is used, we could maybe measure how much glue we're using for each car, but it'll be very expensive and very hard to do, and that's just not worth it. So instead of keeping track of exactly how much glue is used in each car, we'll just call it indirect materials, and we'll put it all together in the overhead. And then we'll allocate it to the car using some allocation method later on. We'll talk about this in the future videos. So anything indirect, any indirect material would actually be part of an overhead, and we could also have indirect labor. And to think about it, I mean, let's say for example, let's think about the manager of the factory. His salary is not directly tied to the car like the production workers' wages. It's not that there is no direct relationship. He manages the entire factory. So we have to allocate his salary to each car using some allocation methods, right? And so the manager would be a form of indirect labor. Also, maybe if we had a security guard that's guarding the factory, his salary is not directly tied to the car either, uh, like a direct labor is. It's indirect, so it's going to be part of the overhead. So to sum this up, the cost of producing a car is going to be the direct materials, and materials that are directly tied to the car can directly be traced to the car. The direct labor is the labor that is directly traceable to the car, and anything that's indirect is going to be an overhead. And these direct materials, indirect labor is pretty straightforward. But with overhead, we're going to take all of it and then we're going to have to allocate it in some way to the car. And that's how we're going to come up with the manufacturing cost of the car. And how we allocate overhead would be a big part of this course. We will look at different ways to do that in the future videos. So direct materials, direct labor, and overhead are all going to be part of a product cost, the cost of producing a product. And whenever we have a product cost, when we incur direct material costs or direct labor costs or overhead costs, that's going to be part of our inventory. So it will not be expense until it goes into an inventory account, and then it will be expense when the inventory is sold. And if you remember from the financial accounting, the expense is the cost of the goods sold. So this will be the process as we incur direct material costs, direct labor costs, and overhead costs. It will go into inventory, and then when it's sold, when it's actually sold when we actually sell the inventory to the customer, like if we sell a car, we'll have the cost of the goods sold expense. All right, in this example we're going to look at a bunch of transactions and we're going to distinguish between transactions that deal with product costs and transactions that deal with selling administrative expenses, and we're going to look at how our product costs are allocated to inventory. Now I have a bunch of business transactions down here. All right. The transactions in the statement model over here are there just to show you guys what a statement model is and kind of review your financial accounting as well. We got a balance sheet here, and I just have assets and equity over here. So this is really our accounting equation, and I don't have liabilities just to make this example simple. But assets equal equity, and this is really our balance sheet. And so we're going to see how these different events affect the balance sheet, and we're also going to see how they affect the income statement. I have the income statement right here on the horizontal format. I got revenue minus expenses equal that income. So I'm just showing everything horizontally, and this example will really help you understand how product costs are handled and also give you kind of a review of what you did in financial accounting. So let's get started. So it says assume all transactions except 6 and 10 are cash transactions or are primarily dealing with cash. And the first one says we acquired 15,000 cash by issuing common stock. And so hopefully you guys remember how to handle this, right? You know the company's cash would go up 15,000 and they'd also increase common stock of 15,000. And we know that has no effect on the income statement. Okay, the second event right here says pay 2,000 for materials that were used to make products. We're buying materials which were used to make the products over here. All right, all the products were started and completed during the year. So this is direct materials. I'll put DM. These are the materials that we're going to produce our products with. So we've already talked about this. What happens when we incur direct material costs? It goes to the inventory. And so let's look at this. Let's look at that and sort of get back to our statements. So our cash is going to go down 2,000 because we bought the direct materials, but we're not going to expense them. And remember, if we have direct material, any product cost, we're just going to put it in the inventory, um, and that's it. No impact on the income statement would be seen, not until the inventory is sold. Okay, our third event right here says paid 1,200 for salaries of selling and admin employees. Selling and admin employees are not our production workers. So they are employees that are involved in selling the product or administrators of the company. So this is not really a direct labor cost, and this has nothing to do with producing the product. So this is simply an expense as it's incurred. So back to our equation, we get $1,200 outflow of cash to pay these salaries, and that's going to be an expense in the income statement. It's expense immediately because it's selling and admin, and now we know that expenses decrease net income. And if you remember in financial accounting, when net income goes down at the end of the year, this expense is closed out, and then the retained earnings goes down to 100. So you can see we incur a selling and admin expense. Cash goes down, which means assets go down and retained earnings go down, and which means equity goes down. And it's an expense on the income statement. Okay, transaction 4 says paid 3,000 wages to production workers. Now we're talking about production workers, and these are the people who are actually producing the product. So this is direct labor. Now we notice that how this is handled very differently when we have direct labor. This is a production cost. So let's look at our equation. So we have an outflow of cash of 3,000, but we're not going to expense it like we did with selling and admin labor. Instead, since this is a product cost, we're going to put it in the inventory. So inventory goes up 3,000. Notice how the product cost and the selling admin costs are handled very differently. Okay, the fifth transaction right here says pay 2,800 for furniture used in selling and admin offices. So this is furniture for selling and admin and not for production. But we are buying furniture for which is a long-term asset. So we're not going to expense this as a long-term asset. We're going to capitalize it as an asset and then depreciate it over the life of the assets. So let's record that. So our cash is going to go down 2,800. So we bought this furniture and the furniture is a long-term asset, right? We're going to put it in the asset account called furniture office for 2,800. And then at the end of the year, as we use, the furniture will depreciate and we will expense it. And that's what's going on in transaction 6. Transaction 6 says recognize depreciation on office furniture purchased in event 5. It says the furniture was acquired on January 1st, had a 400 estimated salvage value and a 4-year life. So let's see how much depreciation we need to take back your financial accounting. So we know the furniture cost 2,800. So as a cost to 2,800, we are just going to use straight line depreciation. This has a salvage value of 400. So we'll take out 400 for salvage and it says as a 4-year life, it has a 4-year life. So divided by 4 and you get $600 a year. And since this was purchased on January 1st, we know it's one full year depreciation. So we just need to take a $600 depreciation expense. But remember the reason we're taking this expense now is because this is related to selling and admin office furniture to be precise. So we're going to decrease the office furniture account 600. Now, if you remember in financial accounting, we really did this in an accumulated depreciation account. Just to save space that I didn't show that account, I'm just kind of taking it directly out of furniture office. But the book value of the furniture office will say this office furniture is shown on book value. The book value of the furniture is going to drop 600 and we are going to record an expense on the income statement for 600, and we know expenses decrease net income, and as we talked about the expense when close out we will decrease retained earnings to 600. So we depreciated selling and admin equipment, which was the office furniture. Assets went down and equity went down by 600, and we showed a $600 expense on the income statement. Okay, event 7 right here says paid 4,500 for manufacturing equipment. Notice that we're buying a different type, a long-term asset rather. Here we are buying a long-term asset that is used to manufacture a product. So depreciation is going to be handled very differently. But let's just first capitalize this cost in a new asset account called manufacturing equipment. So we'll do that first. So the cash account going to go down by 4,500 because we bought this equipment and we're going to capitalize it in a manufacturing account, equipment account. Another asset account. So increase that account 45 by 4,500. Then at an event 8, it says right here, says that we're going to recognize depreciation on the equipment purchase at the event 7. This is the manufacturing equipment. It says here that the equipment was acquired on January 1st and had a salvage value of 1,500 and a 3-year useful life. So let's figure out our depreciation then. So one full year of depreciation since it was purchased on January 1st. So the equipment cost 4,500, had a $1,500 salvage value and a 3-year life. So it's going to be 1,000 a year. So when you take $1,000 of depreciation basically, but I want you to notice that we are going to handle this depreciation differently than we did for the office equipment, which was selling and admin equipment. This is a product cost. So instead of expensing it, it's going to become part of the inventory. Let's look at that looks like in the statement down here. So we're going to take $1,000 out of the manufacturing equipment account. And remember, this is shown at book value. And then we're going to expense that. That's not going to be depreciation expense, because remember, this is a manufacturing equipment. It's a product cost. So this is going to go in the cost of the product. And it will be expense when the product is sold. So instead of depreciating, adding it to the expense on the income statement, we're going to add it into the inventory account for 1000. So notice how depreciation works differently when we're talking about a piece of equipment used for manufacturing versus a piece of equipment that's used for selling and admin. Okay, just notice how it works very differently. Product cost always goes into inventory. All right, then at even 9, it says right here that we actually sold some products. So it says that we sold inventory to customers for 7500. So we just record the sale we got, the cash we got from customers at 7500, and then we're going to record the revenue, which will be at 7500. And we know revenue is going to increase our income to 7500, and net income will go up to 7500. And then we know when revenue closes out, it increases retained earnings, so 7500 over there. So the sale increase cash, increase assets, and increase the equity. And then our last event, event 10, says that the inventory in time, event 9 cost 4000 to make, so the cost of goods sold was 4000. So let's record that. And so we're going to take 4000 out of the inventory account, and that will be our expense on our income statement. And expense decreases net income, and when closed out, decreases retained earnings. So notice this event 10 right here. This is when product costs are expense when the inventory is sold. And its expense. Remember this expense account right here. Remember in financial kind, this is actually on the income statement called cost of goods sold. So product costs are not expense until the inventory is sold, and it's expense in an account called cost of goods sold. All right, so if we find our ending balances at the end of the year, we're going to end up with 9,000 in cash, 2,000 in inventory, 2,200 for the book value of the office equipment, 3,500 for the book value of the manufacturing equipment, common stock will be 15,000, and retained earnings will be 1,700. And then our income statement will report 7,500 revenue, 5,800 of expenses, and that will give us net income of 1,700. And so I hope this example really helps you understand how product costs are handled when we have direct materials, direct labor, or overhead. It goes into inventory and is expense when the inventory is sold.